Alrighty. Let's get this risk disclaimer out of the way, and then we'll get into the actual video. That's enough time. Alright, we'll begin now. So I'm going to mark up my chart with you today, so we can do this together, and we're going to look at certain levels together. So yesterday's liquidity pool that we're looking at, the pre-market high, is untouched, and we're going to look for that at the open. I basically just want to see a run up, leaving the London as the low of the day, and then running up as far as possible. We'll be taking it just exactly how we did yesterday, step by step. So each liquidity pool will be referenced one at a time. So first the pre-market high, then like this analog, then these relative equal highs, then the next set of highs, the next set of highs. So we'll be doing it like that because it's a lower probability environment. The biggest draw to me today is going to be on the regular trading hours chart. So I don't mind a bit of a run lower the open. That's fine because 9:30 should be a bit of a manipulation. But yesterday's regular trading hours gap has got some liquidity inside of it. I'm going to mark that as RTH gap engineered liquidity. And then above it, this is all a liquidity void. So all this area is void. There is no price action in here on the regular trading hours chart. We will be looking for that to deliver after we see it manipulate the sell side first. So I don't know how much sell side we're going to manipulate, to be honest. Normally I have a decent enough idea, but today I don't have that because we've got smooth lows, we've got equilibrium points in our range. So what I'm going to do is wait for the 9:30 move lower, and then we're going to look for higher prices. It is a no news week. It's also August. August is a low probability trading environment, notorious for sucking. But that's okay. We can navigate that. And the purpose of today's lecture is not going to be repeating what we said yesterday. Yesterday's lecture was basically just about encouraging you to wait for specific times of the day and not rushing in at certain times like 9:30 or 9:50 or 10, just qualifying your setup around those times. And today's going to be a bit different, a bit more practical, and a bit more price action oriented. So we're not just going to say, okay, wait for this time of the day, wait for 9:50. You should do that. Don't throw that out the window. But this will be like the second part. So what else do you do? That's just one factor. Time of day is just one factor. That's the price axis. We also have the price axis. So that's what we'll be looking at. And our main focus will be on inefficiencies. So you can see I've already got yesterday's first presented fair value gaps, got some end dog levels. This is another fair value gap from yesterday. It's two fair value gaps. We don't need to label it, it's just fair value gap. You can see how it's holding so far. Now the regular trading hours levels, these are not only referenced on the regular trading hours chart, they are also referenced on the electronic trading hours chart. So anything you see here Currently I've got it set to electronic trading hours, but this gap is calculated from the regular trading hours close and open. It's not only used in the RTH, it's also used in electronic. If I go down to the 15-second, you can see the way it's wavering around these levels, and every time it fluctuates and turns around, where is it doing it? At one of these levels. And that is what we'll be looking at. We'll be looking at this, but our main focus is going to be on the 1 minute, not this time frame. Yeah, I can't cover everything in one stream, but I can do one thing at a time pretty comfortably. These fair value gaps, you can see it stays above the midpoint. Here, the bodies of these two candles stay right within it. It closes at the low, takes off from the low, comes back into it, a little run beneath, but then what is left on the run up, it leaves these wicks. Bodies stay in the upper quadrant, touches the upper quadrant, runs again, and these are relatively good highs. This is the pre-market high. It could be that it's a black bell right at the open, and then it uses the black bell to go fill in the opening range gap. So there's many different scenarios, but we're not going to hold them concretely. We're not going to marry our bias or narrative. Just going to chill for the first part of the session until we can determine that it's behaving algorithmically. So far, I just had a big run at the open. London lunch and pre-market didn't do a whole lot until 8:30. Then 8:30 comes in. It's a big 2022 model. See, it sweeps some sell side, gives you a market structure shift, gives you a fair value gap entry. This is 2022. Little tip for you: if you trade the 2022 model or anything around it, 8:30 every single day has potential of being a 2022 model. So today it was. Where do you see the FVG? The FVG is from yesterday's New York session, if that's the one that you're referring to. I've got 3 minutes until the open. I'm just going to give a quick breakdown on what these PD arrays are. So now bottom left, you can see a 5-minute chart. I am referencing this a little less, but I'm still referencing this. And these are the daily chart levels. So we've got the fair value gap, and it's graded with octants. Octants are these levels, 4 quadrants, 4 octants. The order block is also got octants on it. You just can't see it on the daily. So if we go down here, see those octants, and that fair value gap there also has octants. So it's just these 3 PD arrays have octant levels, and yeah, that's what we're using. So got plenty of levels to refer to. There is zero shortage of levels. I'm never short of trading levels to use. Still tells me to change it to 1080p, but I've already done that. It's kind of weird. Right, set the open. There's a pre-market high. This could be a black bell to go to the downside. Previous day low objective. We already took the previous day low. Alright, so at the open, you don't want to rush in. If it's a black bell and you're familiar with trading the black bell, then of course you can trade it. But you are counter trend trading because I want to be bullish. I know that we should probably have the initial run to the sell side first. Maybe down into these inefficiencies, taking out those smooth lows just because of the opening range gap, which I'm gonna take now. It's not a black bell. Not yet. Okay, it's taking the smooth lows. It's going to the fair value gap. So that's good, because if it leaves these relatively equal, it's a pretty easy point to run back into at a later time. We're not going to concern ourselves too much with opening prices today, not as much as yesterday. I want to only glance at the S&T. I don't really want to spend too much time on this either. The main idea is to stay on the 1 minute chart. What's the order flow here? Yeah, so I said today's stream will be more practical. What do I mean by that? Yesterday's was focused on waiting for specific times of the day, and there were some price action tips too, but it was mainly just wait for these times of the day on a day where we expect a low probability price action. Today's more practical, so we're going to be waiting for certain price action signatures, not just times of the day. We'll blend that in too, but it's the price action signatures that we're looking for. So one of the first price action signatures you should always look for in a New York session, especially on a low probability trading day, is a first presented fair value gap. Until you get that, you don't have a means, or rather like a measurement tool, to measure the order flow. You can visually see it, but the first presented fair value gap, when you get this in price action, and then you start to see, okay, price has inverted it. That tells you a lot. If you see the price has stayed in the upper half of it, that tells you a lot. Without this, you don't have, the tool to really measure what's going on. Whereas when you get the first presented fair value gap or a first presented order block or whatever, you can actually like measure what's going on. You're not just seeing it; you have a measurement tool. You have a gauge, so that acts as the focal point of your order flow reading. Currently, we're swept a low, we're going to a fair value gap, we're staying in the upper quarter, basically at the high of this previous day fair value gap. And we've seen it displace higher above the VSP, and that is a market structure shift. We want to see, can it continue higher prices for our regular trading hours gap engineered liquidity pool. Let's touch the upper half there. The reason I'm using these is to highlight key levels. So it's not just the dotted line in the middle of these little boxes that are just magic levels. It's the quadrants, it's the high, it's the low, it's if you trade below it, if you trade above it, what happens when you trade above it. There's more than just the middle line. Alright, that might become a first presented order block, so we'll keep that in mind. You should not be taking any trades yet because there's no black bell model and there's nothing to trade off of. I know that's a sweep, but it's not a reliable trade yet. no first presented fair value gap, so we're just going to keep waiting for that. And the advantage to waiting for it is when there's a session that takes a long time to print a first presented fair value gap, that means there's not many inefficiencies. Well, it means there's no inefficiencies. And if there's no inefficiencies, then price isn't moving with displacement. It's not moving algorithmically, it's moving high resistance. So the second, I guess you can call it benefit, or like you're killing two birds with one stone by waiting for a first presented fair value gap, because not only are you waiting for your order flow measurement tool, but you're also not engaging in bad price action. You're not getting involved when price isn't really that low resistance. Because right now, what is this? This is high resistance. It printed high prices and it overlapped it with lower prices. We need to see a one-sided market. We need to see a first presented gap. We need to see, these PD arrays being respected. Our measurement tool, which is our first presented fair value gap, that needs to come in price. So by waiting for those tools, those price action signatures, you're avoiding certain conditions. Like we still haven't got a first presented fair value gap. There's nothing yet. These are now 3 equal highs. It didn't run into our regular trading hours gap engineer liquidity just yet. It rejected yesterday's lowest octane. Once again, a random line. There's our consequent encroachment. It's not a super large opening range gap. It's 120 handles. It's not a super large opening range gap. 120 handles. Used to be quite big. Now that's just average, maybe even a bit on the small side, to be honest. S&T. A little bit. Now that we've hit our consequent encroachment, we've satisfied one of our sell side draws. Now there is still, the idea that we could fill the entire opening range gap, which, that's always on the cards. But we want to see, does it start to print reversal signatures now? Still no first presented fair value gap, so we're still waiting. Remember, yesterday we were waiting for a certain time. Today we're waiting for time and price. So now we're going to wait for a first presented fair value gap. I say it like 20 times, but I gotta keep saying it. Just patiently waiting. This is the hardest part about trading because you're seeing it move, but none of the things that you need to, reprice to engage it are there. But it's moving, and that's when you get FOMO, fear of missing out. The only thing I can say, there's no magic trick. It's literally just as simple as not clicking any buying or selling buttons. Just stay on the sidelines, wait for your tools to show up, and then we can actively engage price. So we don't even need octans because the market's moving rapid enough that if you're using quadrants, that's fine. I will keep it as Uh, yeah, I'll keep it as auction levels. Pre-market lows down here. Looks like we're going to get the full gap closure. Still no first percentage for Velric. I was thinking that might be one, but you can see that it's gone all the way up. And that's definitely too small. You're not looking for what is technically a fair value gap, you're looking for what is obviously a fair value gap. Something like that does not constitute a first percentage fair value gap because it's too small. That is not enough to measure order flow or inversions or anything like a reversal pattern. You need something significant in size, which we just haven't got yet. The low on this gap is 573. Okay, that's a full opening range gap closure. So now that's another sell side draw fulfilled. We can start to see if there's reversal signatures or if it wants to go for the pre-market low. Remember, we're not participating yet because we're waiting for our first presented fair value gap. So yesterday we waited for the macro. Today we're waiting for that fair value gap. You can't run in just because it's moving. You have to wait for your signature to show up. And our signature today, and in most sessions, should be that first presented fair value gap. I know that the discussion about immediate rebalance is like first presented immediate rebalance amongst some more advanced students. And on those, yeah, you can participate, but yeah, that's not really what I'm aiming to teach today. Because if you're looking at first presented immediate rebalance, you've got that one up there. But we're not, we're not trading that. We're going for what is obvious, what is easy to visually see. And for everyone, pretty much everyone can identify fair value gap. If you can't, you can learn it in 5 minutes. You can't effectively use it in 5 minutes. That takes a long time to tape read and stuff, but you can learn what it looks like in 5 minutes, pretty much. I told my little cousin the other day, he's like 11 years old. Not the sharpest tool in the shed either. Alright, see the body stayed at that low. Good, and now it's had that rally. We want to see now reversal signatures. So a market structure shift, a change style delivery, an inversion, a V-shaped reversal. That there is a V-shaped reversal on the 15-second with an IFVG. So that is a V-shaped reversal on the lower time frame, not the 1 minute chart, but it is there on the 15-second. I'll wait for the reversal signature to show up on the 1 minute though, so I'm just pointing that out to you just for the sake of it, but to me, what qualifies a reversal signature would be this. So closing above that little line there is our first sign of reversing. Let's see if we've got an SMT or anything. 332. It is an SMT, it just doesn't say it's an SMT. This indicator, I feel like it gets worse every day. Still, there is no first presented fair value gap, so we're going to continue to wait. It didn't close above, so that is not a reversal signature just yet. We need to see it close above. I know ICT is really adamant about, well, in 2025 and 2026 has been very adamant that an order block is the second it has one tick of price action above, that becomes an order block. I've never seen it that way, and he's taught it the other way around before, so he's contradicting himself again. Because he said before that it needs to close above and change their delivery. So I don't know why he's just, I don't know. 936 is too small, so even though that's there, that's too small. I don't consider that. Even though it's a volume bounce, it's a doji candle. I don't like the doji candle. So ICT taught in 2025 that with a doji candle, you don't draw it to the doji candle, you draw it to the candle previous to that. But that one is overlapping the range. Change the color on it. It's overlapping the range of that. So I wouldn't take it. And even though, like, if you were drawing it like that, obviously that's too small. That one is enough size, but it's overlapping the range. And I wouldn't draw it to the volume imbalance because it's a doji candle. Size does matter. Alright, see how it failed to change the delivery. This is why, I'm the most devout ICT student you'll ever find. I've watched all his content multiple times, but I can't agree with him on the change step delivery thing that he's been talking about recently. I need to see it close above the order block level. Because if it doesn't close above, it's just using it as a rejection block to go lower. Like that. So that's why, I don't. It feels like I'm being disloyal when I say I don't agree with him. But I don't. I need to see it close above, otherwise I can't trust it as a reversal. And that's why I said, if it closes above, that's the reversal signature. If it doesn't close above, you don't have anything yet. Right, I'm just going to go for the pre-market lows, trend line liquidity, slash low resistance liquidity. What trend line traders doing it? Trend line traders bought that candle and they got smoked. It's pre-market low. And this looks like it could be a first presented fair value gap now. Hopefully. I wouldn't want to see the London low taken. I'd prefer that stays the low of the day. It's not the end of the world if it doesn't. It can still reverse if it doesn't. But I would prefer this stays as the low of the day. It's always easier to trust it when London makes the low of the day, if you want to go long. It's always easier to trust, in my opinion. But again, it's not required. Like if it does go take that out, it doesn't cancel out a reversal. You can still reverse. Alright, now we've finally got a first presented value gap right as a macro here. I'm hoping you can see the difference in the price delivery from here compared to the price delivery from here. See, in this one, it's back and forth where it goes up close first, and every down close candle's got a wick that goes through it. So you got wick up, wick down, wick up, wick up, wick down, wick up, wick down. Here it's just one solid pass through, and that's why this qualifies us to now start looking for potential trades. So the easiest and most obvious reversal signature here would be inverting our first presented fair value gap, closing above it, and then using that for higher prices. That's the easiest, most obvious level to look at. So you shouldn't have taken anything inside of this range because we didn't have a first presented fair value gap yet. So, you know, it's beneficial to not have traded that, even though it looks like you missed out on a move. Okay, it did take the London low. That's fine. It's not problematic. It's just preferable that it doesn't take it, because then you've got an easier. Well, for me, it's easier to trust. And now we wait. There is one standard deviation. We can bounce off the end dog. That'd be pretty nice. Alright, first presented fair value gap comes in two forms. Well, it comes in lots of forms, but we're going to break it down into two. A BISI and a SIBI. A BISI is a bullish fair value gap, and a SIBI is a bearish fair value gap, to put it in the simplest terms. So if this is a down close, it's a SIBI. If it's an up close, it's a BISI. So that is our first presented fair value gap classification of the SIBI. I'll make it red. And then if we can find a first presented fair value gap classification of a BISI, we'll also look at that. No, busy just yet. What do I want to see? I'm looking to short as old. What is a fair value gap? The fair value gap is a single pass-through on the sell side or the buy side, which means that there is poorest price action within that pass-through because it's only delivered sell side, so it's only given lower prices. There's not been a point in here that delivered higher prices. Well, there's not been many points because there will be some kind of upticks, but it's porous, so it went a lot down, and then it kind of had a couple of upticks, a lot down, it had a couple of upticks, and a lot of this is left undelivered on the buy side, so it's only given lower prices. That is a fair value gap. And you can flip it for a bullish scenario. Okay, Otaku, what I want to see is a reversal into pre-market high, silver bullet style, or 2022 style. And to begin looking for that, I gotta see us invert this, which is a big ask, but because we've had a larger, like a really large move to the sell side, I need to see more to trust the bullish side of it. So I got to see this become an inversion, then stay in the upper half. If it doesn't do that, no harm, no foul, because we're not trading this. The only I'm not putting anyone in a trade to be clear, but to me, I want to see if we can get up above this, then it's a potential scenario to take something. If we're below, not taking a single thing. Doesn't matter if it keeps going lower and lower and lower. It's irrelevant. I don't care. The only potential scenario that I could trust here is if we can invert this. Okay, a Bissy and a Civvy. I'll explain that now. A Bissy. I'm so bad at spelling. Alright, that's what it is. A bullish fair value gap is a Bissy, a bearish fair value gap is a Civvy. A buy side imbalance, a sell side inefficiency for a Bissy means that here we've only delivered buy side. We haven't delivered much sell side, so it's only offered higher prices, meaning that it's an imbalance toward the buy side. So imagine you've got a scale, like the old-fashioned scales, where it's only like if it's heavy on one side, it dips into the left. Imagine it's like that. So it's imbalanced to the buy side. It's only given higher prices. It's not given any lower prices. Well, not much lower prices. And here it's given only low prices, so it's imbalanced on the sell side, and it's inefficient on the buy side. Well, a Bissy or Civvy contain multiple fair value gaps. So a Bissy or Civvy is a type of fair value gap. So if I remove Civvy here, that is not incorrect, it is a fair value gap. But then what type of fair value gap is it? It's a Civvy. So, Civvy. It can be multiple fair value gaps, so this example here, where you're seeing this fair value gap, if you go all the way to the left, you'll see that this is not just one, this is two candles, so that would be an individual one, and then that would be an individual one, but because they're adjacent, I just smushed them together and made it two. So it's, yeah. Victor, you should watch my Silver Bullet Mentorship on YouTube. It's free. All you gotta do is go into the playlist section on the channel. But I think you're new here. I've never seen you around. Am I wrong? Oh. What's your username? This still has not become an invasion. It's rejected, and we're seeing that the delivery is not super clean. Remember, this is the protocol for today because we're in a very low probability condition. That's the main reason that we're taking it this low. Like, yeah, if I was streaming to the roundtable on a regular day, we would have been looking at this stuff over here as well. But because we're exercising a protocol for a lower probability day, we have to demand certain things at our price, because otherwise you can see signatures and they fail. You could see something that would normally hold up, like you might have normally said, okay, that's from some sell side, it doesn't need the full low, we can reverse from here, and blah blah, which you would have been wrong to assume that, but let's just say that was your thought process, and normally that would hold up. In a low probability condition, those types of signatures can fail. You have to demand specific things, like first presented fair value gap, like specific time of day. So today we demanded 9:50 to come around and a fair value gap to come around. We've gotten both. Now we need to see the order flow, which it's not given us anything so far. We're waiting for it to become an inversion. If it doesn't become an inversion, we don't get any trades. It is what it is. Not that I'm trying to put anyone in a trade. It's all hypothetical, you see. Oh yeah, I do know who you are. Never mind. Right, so I put standard deviations from the opening range gap. Let's go onto the regular trading house chart for a moment. So you've got 100% of our gap. Say it's this rectangle. I'm going to put in the middle line here, big white line. If I do a box that's about half that size, you can see that this 0.5 level is half that box away from price. You can see that roughly. As I drew it kind of roughly. And then this one standard deviation is another 50% slash another box. This 1.25 is half of this, so half of this is like there. That's what standard deviations are. You're working a certain percentage away from that range. So if this was our range, and say hypothetically that's 100 handles, a 50% deviation is 50 handles away. So say that's 50 handles. Another 50% is a 100% deviation that is 100 handles away, 25% more. That's 125 handles away. And that is to be treated algorithmically. These are not distribution expectations. These are actual algorithmic levels that will be referenced. It's like a fulcrum. A fulcrum is a distribution expectation. It's just a measurement of how far price can potentially go. Whereas these are not just how far price can go, it's an actual support and resistance level, I guess you can call it. Something that we measure order flow from. Real support and resistance. Alright, it swept a singular low here. We tested it. And now, this entire session we have not got first presented BISI. We've only got the SIBI. So we only had it move lower. Nothing inefficient to the buy side. So you can't trust a buy side delivery setup. So you can't trust a long until you get a first presented BISI here. Because, how much buy side delivery have you seen this session? A little bit, but nothing inefficient, or rather imbalanced to the buy side, only inefficiency to the buy side and imbalance to the sell side. So we talk about order flow. We're not just saying, a big element is respecting key levels and stuff. How do we deliver around PDRAs? But it's also simply how many inefficiencies are there? There's not even one bullish fair value gap or BISI. Not even one. Also, because we've crossed 10 a.m., we can look for a 10 a.m. first presented fair value gap as well. It's super slow. Alright. It's not abnormal that if the 9:30 open has a huge move, that the 9:50 macro doesn't do that much. If this macro doesn't do that much, you've actually got insight into what the next macro is going to do. So we know that because this one didn't do that much, 10:50 to 11:10 is more likely to have significant movement. That's from a trader roundup. It's so slow. Please do not mistake this for a support and resistance level. That was simply me acknowledging that we took some liquidity earlier. We didn't really do anything. Alright, let's look at some opening prices. Let's try and stay away from them this session, but because we returned to them, I'm gonna take a look. So it was a classic buy day until the 9:30 opening bell and a huge sell-off. To be honest, I'm not getting that much insight into this. We can look at that. Random active price action. Went above midnight opening price by 1 tick. Then we made a new low. Alright, ES is nowhere near as low as NQ, so these are decoupled. YM is doing the opposite, it's actually running higher. So that's decoupled. I would like to see ES hold, and then in turn bring NQ higher. Because if this can hold the fair value gap and not go for sell side, yeah, we're way higher up on NQ than ES. On ES than NQ, I mean. So if this gap here can hold, it makes it much easier for NQ to fall back in line and start delivering buy side instead of being so bearish. Guys, like the stream. There's 20 of you here. What, do you hate me or something? We can use more standard deviations on the opening range gap. It isn't necessary. I'm only doing it out of curiosity. Like, I don't care if it holds these levels or if it runs through or if it respects them. I'm looking mainly at this. This is the only, it's my focal point. Anything else is basically not relevant to me. It just adds, confidence and conviction if we start to respect these, but yeah, the first presented gap, that's all I'm focusing on. So Forex also so slow and low probability to futures. Look, with Forex, you mainly want to trade it. The dollar's actually moving on the daily chart. Oh, nice, it is. So look, the dollar's gone down tremendously today. If we go to pound dollar, bet it's gone up. Yeah. So on days like that, you want to trade Forex too if you want. You don't need to. But classic buy days, classic sell days. Euro dollar. I think it was more of just a slow grind. Like it's not exactly clean price action. There's no classic buy day here. No classic buy day. But for Forex, just ask yourself, is the dollar gonna move? And if it is, then you can trade it. So if you go here, dollar, and here I go, euro dollar. Yeah, that's what Forex looks like if the dollar isn't moving. So today, huge down movement, Forex taken off beautifully. Yesterday, consolidation on the dollar, consolidation on the euro dollar, seek and destroy, terrible. Not not a very nice day either. I mean, it's okay, but it's not that great. And here, what day is that? 14th August. Sell-off day on dollar, big bullish day on NQ. Sorry, on euro dollar, that's good. Consolidates mainly, consolidates mainly. Yeah. Basically, Forex is super hit and miss, where if the dollar's not doing anything good, then nothing's going to really happen. But if the dollar's moving nicely, then your pound dollar and euro dollar pairs are going to move nicely. And so is gold. Like, if you're in the round table, the move I called on gold, like, I don't know, move a week or 2 weeks ago, that was only because of the dollar's movement. Okay, finally seen some good enough delivery on the buy side. This needs to become a fair value gap, and if it does, you've got inversion fair value gap, and you've got bullish fair value gap. And that would hopefully be the beginnings of this run higher. It's got to be a good fair value gap. It's trashed and lazy. This is kind of mediocre, but it's acceptable. We'll make do just for the lecture, but I wouldn't use this. So that is our 10 a.m. first presented busy. Of course, this is your 10 a.m. first presented CB. Inversion. I would prefer the inversion because it's not the exact same size, I'm saying. But ideally, that holds and takes us into our first presented gap. So low, low. It is, okay. So in one sense, it is a V-shaped reversal, but everything here is just barely. Like that's just barely a sell side sweep, barely an IVG, barely a first presented fair value gap. So in a low probability condition, I'm still not taking it. You have to remember that we are in the or one of the lowest probability months of the year, August, in one of the lowest probability weeks that we've seen in a long time because there's not a single economic counter event. So, it's just an all round trashy market. So you're not going to get that many setups if you're demanding good quality setups. If you're just going for the willy nilly stuff, then yeah, you'll get loads of trades, but you'll probably lose money. And no one likes to lose money. Alright, so this is the week fair value gap. Week. Alright, we will end the stream here. It's been it's been informative, but the price actions obviously fell off pretty dramatically, not been that great. But that's okay. We're not too bothered. I will be streaming again tomorrow. See you guys tomorrow for another lecture. I'm not going to do this low probability protocol streams like the entire time. It'll just be for this week, because this week is lowest probability month, lowest probability week, with no economic counter events. That's the only reason we're doing it in this style. But we'll be more free, a bit more, not gung ho, but we'll look at more opportunities outside of, being super restricted. Next week, that'll be. So thank you for watching. Like the stream if you like the stream, and I'll see you tomorrow.